Good evening, everyone. Time for another silver update. This is our weekly chart. I don't pull this one up very often just because it's such a long-term view, but there's some interesting technicals on it. First thing I want to point out is the length of the base that we have here that we've broken out of. You can see that this base actually runs from about 1998. This top here is the Buffett purchase of the 100 or so million ounces, and it spiked, didn't come back and visit that price until a good 6-7 years later in 2004. Now this base actually runs all the way to about 2008 in the fall when we visited those lows again after the financial collapse. So that's a good 11-year base that we're looking at, and normally in technical analysis the size of the breakout is often corresponds roughly to the length of the base. The longer the base, the more violent the breakout and the stronger the bull market that ultimately results. So this, in my opinion, is still just a early stage in this bull market, and obviously for fundamental reasons, but I think also for some technical reasons as well. The other line I've drawn here is a trend line of the tops, of the spike tops that we had in 2004, 2006, and 2008. And we also had a spike top in 2010, 2011. And then a strange thing happened. Instead of correcting like these others did, these three significant corrections after each one of them, this time we had just a little drawback, little pullback, and then blast off out through the top of this trend line. It's not a support line because, remember, support lines are always flat lines. The reason why, and this actually isn't a flat line, it's more of a trend line, but the reason why support lines are always flat lines is because you've got to remember the key basis behind all support and resistance is that somebody who's purchased at a prior time or sold at a prior time is looking to get out at that price. So it has to be a flat line to be legitimate support and resistance. Anything else is a trend line. But what you will notice on this trend line, if we pull out a little bit to the daily, is that we intersected the tops and then we came back and just met this, and this is where we took off from 3250. So the market is maintaining its, I'm not going to call it overbought, but its strong trend above this line. Normally if it was following the pattern of these, it would have fallen through there, and then we draw our top up here and then go higher, but it seems to be entering new territory. We can't say for sure. We have to just wait and watch the price. But the other thing I wanted to point out is that our weekly is now starting to correct on the MACD. We've actually put in a significant top on the MACD, and we're already coming back down towards the zero line. Now, some of these past times it's played out differently. If you look in the 2006 top that we put in the top on the MACD, and then we came down and the price just did some churning until it kind of leveled out, touched the zero line at a higher point, and then we rallied to the next top. Now the next top we actually came down, and once we hit the zero line, that's when we absolutely plummeted in price. So the question being, is what's happening now something similar to what happened in 2006 or something similar to what happened in 2008? For a number of reasons, I think that what we're seeing now is actually something similar to what happened in 2006, or even more aggressive than that. So we'll have to wait and see on that. I think we're approaching something like the financial end game, and I wanted to jump over and read quick missive by Bix Weir just to remind people of the reason why we're investing in physical silver and the potential catastrophe that we're facing. You have to have the long-term, big picture view, and I think Bix outlines it pretty clear here, so I'm going to go ahead and read this. He says, in the meantime, there are a few things you should keep in mind as we approach the global collapse of the monetary system. 1. The 2008 meltdown was averted by the banksters due to Hank Paulson holding the U.S. Congress hostage. The problems were not solved, but rather delayed for a few years. Now the meltdown begins again, and the banksters will not be saved this time. 2. Gold and silver prices are 100% rigged with computer programs, so no one knows their true fair market value. The market riggers can place the price of both metals wherever they want at any time, so you must be mentally prepared for anything. 3. The global fiat monetary crash will destroy all markets and trading platforms, so getting a handle on what the true value of gold and silver is may not be possible during the crash. Keep all your gold and silver investments in real metal and out of the hands of others. No one will survive the crash financially intact. Even honest third-party holders of metal depend on continued functioning of the global monetary system. 4. The global monetary meltdown will destroy all banks and brokerage houses and cause global chaos, so be ready to hunker down for a while. Plan on a few months of chaos. Be prepared to lose all of your virtual assets that are held in electronic blip form held at financial institutions. Virtual assets, electronic banking, stocks, ETFs, derivatives, 401ks, etc., are very new constructs, less than 40 years old, and their fragility is high. Those who invested in the tulip mania in the 1600s would laugh at our electronic blip mania. 5. You will need some physical cash on hand to ride this out as the banks shut their doors and people line up around the block to get their money out of the system. Unfortunately, there will be no money in the banks as their leveraged business model only survives in a continued growth mode. Over the past 3 years, we've passed through the eye of the financial hurricane. This summer, we will have to pass through the backside of this storm. We will get through it, but the destruction will be total. This creative destruction event is necessary for us to drain the swamp and then to rebuild a more fair and viable system. May the road you choose be the right road. Excellent. Bix Weir. Excellent. I 100% agree. I think that Bix is right on. Regardless of what you think of the road to root of theory, I think that Bix is correct that we're heading into a financial catastrophe, the likes of which the world has never seen before. And it probably is going to result in the evaporation of all financial assets, all debt obligations, which is all stocks, all bonds, all currencies, all retirements, everything, paper is going to go. So you have to keep stacking. I agree with Bix that you want to keep a certain amount of cash on hand, at least enough to get you through, say, a couple months of expenses. I'm not talking about mortgage and things like that. I don't plan to pay if my bank account is locked up, then my mortgage lender is going to be locked up. If I can't pay electronic payments through my bank and I'm not able to receive them, then my credit cards aren't going to get any payments either. So I'm not talking about that. I'm talking about groceries and keeping the lights on and utilities and going down to the city and paying in cash, keeping up cash for a couple months, 2-3 months maybe, to get you through to where things settle down. Now, a number of people have asked me about, in fact, are continually asking me about stocks, specifically mining stocks. So I've pulled up a chart here. This is one of the larger ones. This is a chart of Pan American Silver. It's PAAS. And you can see I tracked it with the SLV, and you can see that it pretty much tracks. I can't go that far back because the SLV doesn't actually go that far back, so I'm just using it as a proxy for the price of silver. I could probably pull it up in Nat Denny as well, but this is sufficient to make the point. You can see that these pretty much tracked each other. In fact, the miner was higher in 2008 and then the collapse, and of course we slowly rallied. And you can see silver took off, the miner didn't. And a lot of people are telling me, and you can see right now there's a real serious divergence in the prices. And a lot of people are telling me, well, you know, the miners lead the market down and this and that. I don't really know one way or the other, and I do not recommend buying mining shares. And I have to repeat myself. If I have to repeat myself 100 or 1,000 times, I will. The reason why is this: the underlying commodity that these miners are mining is silver. That is suppressed. It is a suppressed price. When the price of the product that you produce is suppressed, that necessarily means that you're going to sell at a loss or come close to selling at a loss, because the cost of your inputs are rising with inflation, but because the price of what you're producing is suppressed, it is not. Hence, it is not a profitable operation. And I do not recommend buying something that is locked into a loss situation. Now, in the future, it may be the case. This also may be showing that they're discounting seizures, because if the type of situation that Bixweir thinks is going to happen, and I think is going to happen, probably most of these countries will seize their mines and those shares will become worthless. If you watch what happened with GM and the senior bondholders, they basically seized the assets of these bondholders. They reneged on 200 plus years of contract law, and they did the same thing with Bear Stearns. So you really don't have any reason to be in paper assets, and I can't warn you strongly enough that you're very much likely, if you are in any kind of asset that says that somebody owes you something, and that's anything but physical silver and gold, that means that you're probably going to lose 100% of your asset. So I'm going to continue to warn people. I don't believe in investing in the SLV. I don't believe investing in the miners. I don't believe investing in Microsoft or Apple or anything else, because, again, it's just an obligation from someone else to pay you a debt in the end. And when the system collapses, none of those debt obligations are going to be honored. Last of all, I wanted to look at a little image here. This is actually from an article that's on Zero Hedge, and it covered the Bernanke speech that was given today. And what he did was he parsed out the entire speech, and then he took the words that Bernanke used the most often and made them the most prominent and down to the least. So an interesting picture here. We can see in order Bernanke mentioned prices, inflation, commodities, and markets and increases. So even though he may say that the economy isn't strong enough and he's not worried about the price of commodities and it may be just a major blip, this is a kind of like maybe something like the reverse speech analysis. The amount of time he mentioned these words, it's pretty clear what's on his mind, and so we may be looking at a deflation scare before we get some kind of QE3. I don't know. If you remember, if we go back to our daily chart, if you recall, let's clear these off here. If you recall, QE2 was announced in August of 2010. So if we draw our chart right here, our line, support line, you can see right after they announced QE2, this is when we took off. This is when we were off to the races. This is the beginning of our trend line that's still intact. So are we going to see something similar, or are we going to see a little mini crash or deflation scare and then an explosion to the upside as some form of QE3 or some form of monetizing or ZERP or something like that is announced because they just can't afford to let the system collapse? I don't know. But we can see from the past that QE2 was the cue for silver to explode to the upside. So it may be that QE3 will be that as well. And we'll talk to you next time.